Good morning. Today I will be presenting on the topic stakeholder specific challenges and strategies in microfinance. So, microfinance plays a very important role in financial inclusion. It provides small loans, financial services to low income individuals who usually do not have access to traditional banking services. So, these borrowers include small shop owners, rural entrepreneurs, farmers, women entrepreneurs, and individuals and understand communities. So, the objective of microfinance is poverty reduction and income empowerment. However, despite its noble goals, the sector faces the multiple operational and ethical challenges. So, what makes microfinance complex? Is it that it involves multiple stakeholders, including borrowers, microfinance institutional, that is MFIs, banks and financial institutions, regulators. So each of the stakeholders facing different types of pressures, risk, and responsibilities. So therefore, in this presentation, we will discuss and understand the challenges that is faced by each stakeholders, analyzed the real world issues in the microfinance, explore strategies that can make microfinance more sustainable and inclusive. By addressing these challenges properly, we can build a stronger financial ecosystem that supports both, that is, economic development and financial stability. So let's talk about the borrowers who are the core beneficiaries of microfinance. Borrowers in microfinance are typically low income individuals with limited financial resources because they lack collateral and credit history. They often rely heavily on microfinance institutions for access to credit. So, however, borrower faces several major challenges, I can say. The first challenge is high interest rates. Unlike the traditional bank, microfinance institutions often charge higher interest rates, sometimes ranging between 20% to 100% annually. So this happens only because MFIs have high operational cost and smaller loan size that gives higher credit risk. But the borrower with already limited income, such high interest rates can create repayment pressure and that may push them into a cycle of debt. So the second issue is multiple borrowing. Many borrowers take loan from multiple microfinance institution at the same point of time. So this happen because the credit information is not always shared across the lenders. Borrowers try to manage existing loans by taking new loans. As a result, they also end up with overlapping loan obligations, which can lead to financial distress. A well-known example is Banco, which faced stronger criticism for charging around 86% of interest rates on microloans. While the institution was profitable, critics argued also that such high interest rates went against the social mission of microfinance and placed a significant stress on borrowers. So, therefore, while microfinance aim to empower borrowers, improper lending practices can sometimes worsen their financial situation and instead of improving it. Thank you. So next, let's talk about the challenges faced by microfinance institutions themselves. So MFIs operate in very delicate environment. They have balanced two important objectives. First is social mission, helping low-income communities. Second one is financial sustainability, maintaining the profitability and the survival. So one of the biggest challenges that MFIs faces is expanding the outreach while managing the risk. So many MFIs aim to serve the rural and remote population. However, operating in such areas increases the operational cost, including staff deployment, monitoring loans, administrative expenses. So another challenge is I can say is portfolio risk. Since microfinance borrowers usually have unstable incomes, there is a high possibility of loan defaults. So MFIs therefore need a strong credit evaluation and monitoring system. Another major issue is dependency on the subsidies and donor funding. So studies suggest that around 70% of microfinance institutions globally struggle to become fully financially sustainable. Many rely on external funding from government, NGOs, or development agencies. There is also a problem of mission drifts. As MFI's growth and said profitability, they may also start focusing on larger loans and wealthier clients. Uh, Instead of poorest borrowers, they were originally meant to serve. This creates a conflict between commercial success and social responsibilities. So, finally, the weak governance structures can lead to mismanagement, lack of transparency, and operational inefficiencies, which may also damage both the institution and the borrower trust. Banks and financial institutions also participate in microfinance ecosystem. Some banks directly lend to microfinance borrowers while others provide funding to MFIs. However, this face several challenges. Like the first challenge is I can say is credit risk exposure. So microfinance borrowers usually have irregular or seasonal income, which makes it harder to access the repayment capacity. This increases the risk of loan defaults, which can affect the overall loan portfolio. Bank therefore need strong credit risk monitoring system to track the repayment patterns and borrower behavior. The second challenge is regulatory compliance. Financial institution must follow the strict regulation related to capital adequacies, customer protection, reporting requirement, anti-money laundering rules. So this regulation increases the administrative workload and operational cost as well. So another issue I can say is licensing and regulatory hurdles. For example, in the countries like Kenya, microfinance institution must meet strict licensing requirement, and this requirement are important for maintaining the stability but also can make it harder for small MFIs to expand their services. As a result, banks and financial institutions must carefully balance the risk management, regulatory compliance, and financial inclusion goals. Another key stakeholder in microfinance is regulator and government authorities. Regulators play an important role in ensuring that the microfinance sector remains stable, transparent, and fair for borrowers. One of the biggest responsibilities is balancing the financial inclusion with the consumer protection. On the other hand, regulator wants to promote access to credit for undeserved population or unserved populations. But on one other hand, they must also protect the borrowers from excessive interest rates, predatory lending services, over indebtedness. Another challenge is regulator face is limited supervision capacity. So in many countries, the number of MFIs has grown rapidly. However, the regulatory institutions may not have enough resources to monitor all the institutions effectively. So this can create a governance gap where when some institution operates without proper oversight, regulators also need to continuously update regulatory framework. So the microfinance sector is evolving rapidly due to digital payments, fintech platforms, mobile banking, and regulatory frameworks must adapt to these changes to ensure that the innovation does not compromise consumer protection or financial stabilities. Now that we have discussed the challenges, let's explore strategies that can improve the microfinance ecosystem. The first strategy is credit bureau integration. Credit bureaus collect and share the borrower's credit information across the financial institutions. When MFIs and banks share borrower data through the credit bureaus, lenders can easily check whether the borrower already has existing loan. This helps to prevent the multiple borrowing and over indebtedness. For example, if a borrower has already taken a loan from two institutions, the third lender can identify the risk and avoid issuing the another loan. This improves the portfolio quality for MFIs and banks. It also helps the lenders to assess the credit risk more accurately. Another benefit is better repayment monitoring. Borrowers know their repayment behavior will affect their credit record, which encourages responsible borrowing. Overall, the credit bureau integration can significantly reduce the default rates, improve transparency, and across the microfinance sectors. The second important strategy is responsible lending and strong governance practices. Responsible lending means ensuring that the borrower fully understands the terms and conditions of their loans. This includes transparency, price, and institutions should clearly disclose interest rates, service charges, repayment schedules, penalties. This prevents hidden charges and protects borrowers from exploitative practices. Another important aspect is ethical loan collection. Uh, Loan recovery should always be conducted respectfully and professionally. Aggressive or abusive recovery practices can harm the borrowers and damage the reputation of the entire microfinance sector. So institutions must also develop strong governance framework. This includes clear leadership structure, internal control, accountability mechanism, risk management policies. Strong governance help ensure the MFIs to remain aligned with their social mission while maintaining the financial discipline. Technology can play a transformative role in improving microfinance operations. One of the biggest advantage of technology is reducing operational costs. Traditionally, MFIs had to send field officers to rural areas to collect the repayment and monitor borrowers. This process was expensive and time consuming. However, with digital payment and mobile banking, many of these operations can now be automated. For example, digital loan application, mobile payments, automated repayment reminders. These tools allow MFIs to serve more clients at lower cost. So technology also can allow institutions to expand their product offerings. Instead of offering only micro loans, MFIs can now provide saving account, micro insurance, pension schemes, financial advisory services. So a successful example comes from East Africa, where mobile money platforms like M-Pesa have significantly improved financial inclusion. Borrowers can easily send and receive the money using the mobile phones, making financial services faster, cheaper, and more accessible. Another powerful strategy is financial literacy education. Many microfinance borrowers have limited financial knowledge. They may not fully understand the interest rate, repayment obligations, financial planning, and risk management. As a result, they may misuse the loans and struggles with the repayment. Financial literacy programs help the borrower develop better financial management skills. So these programs teach borrowers how to plan budget, invest loan productively, manage their savings, and avoid unnecessary debts. Studies have also shown that MFIs that offer financial literacy programs often experiences higher repayment rates, lower default levels, and greater consumer satisfaction. Most importantly, the financial literacy empowers the borrowers to make informed financial decisions, which improves their long-term economic stability. To conclude, microfinance has tremendous potential to promote the financial inclusion and economic empowerment. However, the sector faces significant challenges involving multiple stakeholders. Borrower faces issues like higher interest rates and debt stress. In microfinance, institutions struggle with balancing the social impact and financial sustainability. Bank faces credit risk and regulatory pressures, while regulator must ensure that the consumer protection and sector stability. To address these challenges, we need to integrate and collaborate the solutions. Some of the most effective strategies include credit bureau integration, responsible lending practices, technology adoptions, and financial literacy programs. When these strategies are implemented together, they can create a sustainable microfinance ecosystem. Ultimately, the goal is to build a financial system that is not only that does not only provide the credit but also empowers the communities and improves the livelihood. Thank you.